APAC meets Wall Street. Today we'll be looking at current market conditions in the US and some key trading instruments that have become very popular, not just on the Moomoo platform, but across the market. Joining me today for the presentation is William Rhind. William is the founder and CEO of GraniteShares, a commercial partner of Moomoo. And he'll be able to not only share his perspective of what's happening on the ground in the US, but also talk us through some of the important aspects of the ETFs that GraniteShares have listed. But before we do that, there's some important information we need to consider. Whether you're sitting in Malaysia or Singapore, Hong Kong or Australia, Moomoo is a regulated and licensed operator of an online trading platform. You can see on your screen here the relevant regulator and license numbers for each region. Very importantly, though, on this page, we state that the information that's been prepared for you today is general in nature. As investors and traders, we all come to the market with different risk appetites, different goals, different amounts of capital, and different approaches, different levels of experience. And all those differences mean that the right decision in any situation is as much a factor of your personal circumstances as it is of the market. And because we don't know your personal circumstances, nothing that's said today should be taken as personal advice. Whether or not any of the information presented today is of importance to you or useful in your situation is a decision entirely for you. You can find more information in our relevant documents. In Australia, that's our financial services guide, and the relevant documents in each region are available on our website. It's important that anyone considering any kind of investment understand the risks involved. If you've studied those documents, you're still not sure about risks involved, please seek independent advice. So bearing that in mind, we'll head into today's presentation. We are looking at a US market outlook to begin with. And as I mentioned, we've got William Rhind with us today to give us a perspective from the US. We'll then move on to look at some of those essentials for ETFs, and in particular, leverage in ETFs and inverse ETFs. We'll get an understanding of what they are and how investors and traders might use them. We'll then look at some of the top performing stocks over the last 2 months in the US. That is our focus today. And we'll look at some of those stocks, those that are on the rise and perhaps those that are declining in popularity as well. And then we'll turn to the Q&A session. And we'd like to keep collecting all your comments and questions. Many thanks to all of those of you who have already sent through questions. We've compiled a lot of them and they've been added to the presentation. But please feel free to keep the comments coming in the comments section. You can see there on your screen at any time during the presentation. Please feel free to put in your comment, your question or query, or anything else you think is important to the agenda, and we'll get to as many of those as we can. So heading into today's presentation, let's start by taking a look at the US market and what might be in the pipeline for investors and traders. And Will, whereabouts in the US are you at the moment?
I am in New York City, Mick.
Terrific, right at the heart of it, right on Wall Street. And what is the outlook from on the ground in the US?
Well, it's certainly a lot better than it was a couple of months ago, back in April. So, today, obviously, just by coincidence, we're doing this webinar and we've seen the NASDAQ hitting all-time highs again. We've got the index, the S&P 500 index, trading now just flat on the year from being down quite considerably. So I think that, things are starting to look a lot better than they were. And some of that volatility that we saw, particularly, in the months leading up to April, the height of the so-called trade war, is starting to come out a little bit, which is good news.
Absolutely. And do you think the recent gains that we've seen are related only to the Middle East, or is there more driving the action at the moment?
There's more behind it. I mean, certainly, I think in the very, very immediate term, we had a big boost today when it looks like, hopefully the tensions in the Middle East can start to simmer down. And we hope, obviously, that that is the case. And that means that investors can start to look beyond the immediate geopolitical concerns of the Middle East. I think probably a good place to start, Mick, is beyond the performance of the indexes. Earnings have been strong this year. So S&P 500 earnings, up 13% year over year. So it proves that companies so far, at least the companies reporting in the S&P 500, reporting earnings and are in good shape. Good shape means that so far the consumer remains resilient, remains willing to spend, and as you know, in the US, roughly 70% of GDP comes from consumer spending. So it's a very, very important part of the economy. Speaking of the economy, we are still at full employment, which is obviously a good thing. Growth in the economy continues to grow, continues to be above trend. And then lastly, the Federal Reserve, the guys that we always talk about, at least once a day, seemingly, if you watch the mainstream financial media over here, are going to cut rates. And we are in an easing cycle. Now, there's debate, obviously, on how many cuts that we'll get. But, it seems like at least one interest rate cut, if not two, potentially more by the end of the year. So, I think that, like I said, the markets are back compared to where we were. We seem to have shrugged off that volatility from the trade war. The market's starting to look beyond the trade concerns. And the main indicators that I look at are pretty positive.
Absolutely. And we're seeing it in a similar fashion from here. Well, the much steadier gains, I think, are very impressive. When we saw that volatility in April, there were days where there were strong gains, but it was pointed out that a gain of 4 or 5% in a major market index like the NASDAQ 100 is actually a further sign of instability. It's not necessarily good news. Whereas the gains that we're seeing, particularly over the course of the trading week so far, appear to be much steadier and therefore much more sustainable. So we are getting confident. What do you think about the all-time highs? And can we push through these levels? Do you think it's a bit of a ceiling temporarily?
I don't think so. I mean, I think because, look, the devil's in the detail between the two indexes. So I briefly mentioned that NASDAQ's gone to all-time highs, but S&P now is just trading flat on the year. And within there tells its own story that what's propelling the NASDAQ versus the S&P is the higher weighting towards the world's largest and most significant tech companies. So this has been, at the core, it was a tech recovery or tech-led recovery. And as I'm sure we'll talk about, Mick, this remains, probably the hottest, investment themes in the market, in the US market, in the world at the moment, which are driving these indices forward at the moment.
Absolutely. And it is all about growth, isn't it? Well, it's that superior growth in the tech sectors is one of the key attractors for investors. And in fact, it was the driver of the US market over 23 and 24. Very strong performance in both years. Good gains across the broad market index, and those gains coming in a way that a lot of investors felt were very sustainable. It was a dip buyer's market, and that growth in the share market at the time was attributed to the fact that the US economy itself appeared to have superior growth prospects, and that was attracting international investment flows as well as local US flows into the market. And just to put that in perspective, we've got here a table to look at the relative growth prospects, inflation, employment, and debt situations with some of the major economies around the globe. Now, between the USA, China, and Europe, we've got about 70% of the global economy. And so we get a picture of the globe by looking at those three economies in particular. But you can see there are some contrasting situations, but the moderate growth there in the US as recorded in the GDP of 2.1% might be an underestimate. It is a broad measure, and we certainly see other growth measures in the US economy that appear to be more resilient than that level. But nonetheless, with inflation modest and employment, as Will pointed out earlier, at just about full. There is room here for the US economy to keep expanding, to keep growing, and the companies and the company profits with it. And looking around the globe, you can see that there are good growth prospects. The Chinese growth is the best of all of the major economies, but it was slowing into September last year, but the stimulus since then has turned that around, and it continues to lead in terms of global growth. But we see from the chart here that in Singapore, in Malaysia, there are also very substantial growth rates. Now, this is painting a fairly benign picture, and given that markets are near all-time highs in many instances, it needs to be a pretty good economic picture. And overall, that's what the impression that this data gives. The concern here, or the dark shadow, is on the right-hand side of this table, and that's the levels of debt. And I would draw particular attention to the debt to GDP ratio in Japan, where it's over 200%, and in the US, where it's over 100%. So we've got debt situations that might come back to bite, particularly as interest rates are no longer near zero. And it's something to keep in mind. Now, when we see structural threats to the market like national debt, it's very difficult to pick the timing or the trigger that will cause the market to focus on them. But debt is often at the heart of major market corrections, and it could well be again if the market chooses to focus on it. I must say that the markets are showing no regard for this concern at the moment. It's not something that we need to keep in mind necessarily today, but it is something for us to be aware of as we head down the track and as the markets keep hitting new highs. So just one factor to be aware of. But as we've discussed, this is the NASDAQ composite, not the 100, but nonetheless, it too is also approaching its all-time high just above 20,000. And there's that volatility we were discussing just before. It's been quite a fascinating ride over the last 3 months with that huge sell-off down 20% or thereabouts at one stage before rallying right back. Now, these are unusual market conditions, and to see a V-shaped recovery like this so soon after we saw one during the COVID sell down and bounce back suggests that there's something special about current market behaviour. And I'm of the opinion as well, and it is only an opinion because none of us know the future, that this momentum that we're seeing, the positive momentum, is likely to take all of the US indices to new highs. And at this stage, it's hard to see what could derail the strength in the US markets. Having said that, there are a number of instruments that have risen predominance in the markets because of the increased participation of individual investors. And that's at trading platforms like Moomoo. We put the power of the markets in the hands of individuals. It's a democratization of markets, and that participation of individuals is changing the way the markets work. We've noted a few other factors, including the premium being paid for household names that are listed, but also we've seen a huge rise in the use of ETFs. Now, of course, ETFs come in many different varieties, and it's important to understand what ETFs do. That what's on the label is what they deliver in terms of market performance. And so understanding what each ETF does is a very important part of the investment landscape. And to that end, we'd like to examine two very important kinds of ETFs. And I'm going to go to our specialist, Will, here on this to help us understand, first of all, leverage in ETFs and inverse ETFs. Will?
Sure, Mick. So leveraged ETFs, probably the most common forms of leveraged ETF instruments out there. Typically, you're looking at a leverage factor of 2 times or 200%. And these all work in a very similar, if not identical way, which is that they provide 2 times, if it's a 2x product, the daily return of the respective underlying asset. And that underlying asset can be a single company, like a Tesla, Nvidia, etc., or it can be an index, the ones that we've talked about tonight, a NASDAQ or a S&P or a fixed income index. And very simply, these have become, very, very popular ways for, active investors, active traders to take advantage of these outsized movements that we're seeing in the market. The other one you mentioned here with inverse ETFs or short ETFs is really just the opposite concept. So these are ETFs that try and profit from falling either stock prices or indexes, depending on what the underlying of the ETF is. And again, try and offer investors an important trading tool in volatile markets, where in the case at least of this year, we have plenty major names in the market that share prices are going up as well as down on a fairly regular basis.
So in the sell-off that we saw in April, did you see a pickup in popularity of the inverse ETFs?
Yeah, definitely. And I mean, again, it's like the tale of two markets. So you have, for example, a name like Tesla that has had wild swings this year, but is still down. Still down, I think, about 10% year to date, versus something like the Nasdaq being up in positive territory. So there's very much a sort of dispersion in the big tech names between some of the winners. I mean, Palantir, for example, which has become a huge AI darling stock in the US, up over 90% year to date. So there are clearly some standout winners here, but there are also some losers. And so being able to tactically take advantage of companies where the share price is falling and companies that take the share price is rising is a worthwhile addition to the toolkit.
Okay. I mean, clearly these are powerful trading tools, but are you seeing anything to suggest that there are some long-term holders of some of these stocks using inverse ETFs to hedge their positions in the short term?
It's difficult for us to know exactly, because we, as the manufacturer, we don't ever interface with the customer directly. In other words, the customer comes to you, to Moomoo, to buy and sell, and we manage the underlying exposures. Now, that being said, I mean, clearly we've been doing this for some time. We have a good idea of what people are doing. And certainly there are some strategies that people employ, because a lot of times what we see is people hold these underlying stocks and maybe have held these underlying stocks for some time. And therefore, if you're a long-term holder of NVIDIA, for example, or a long-term holder of Palantir, name it, you're probably sitting on a lot of embedded capital gains. So these are investors that don't necessarily want to sell those, and therefore they don't want to trigger a tax event, but they want to be able to trade around them. And sometimes that means profiting from short-term moves up to the upside around earnings or other special events. But other times it means maybe holding a short position to try and generate taxable losses, for example, to be offset against gains, or for other situations such as what we saw in April, where almost all of these stocks indiscriminately went down with the market on the back of the trade war news, or at the height of the trade war news.
Right, yes, of course. All right, well, thank you for that. Just going back to leverage, it's important to note that leverage has the effect of not only potentially multiplying gains in the market, but it can multiply losses as well. So it's something that every investor who's considering employing leverage in any way should think about, but especially in leveraged ETFs. Are people holding these for longer term gains, Will, or is this more of a short term trading instrument, the leveraged ETFs?
Yeah, the vast majority, Mick, I would say it's over the shorter term. So we as a company manage on any given day $9 to $10 billion, of which 2 to 3 billion turns over on a daily basis. So I think within that you can read that the vast majority is being traded on a pretty short term basis. So that doesn't necessarily mean intraday, although I'm sure people are doing that in some sections of the market. But it might be a day, couple of days, a week, etc., as people fulfill whatever trading strategy they are. So I think it's rarer to see people holding it for the long term. And of course, for people holding these products the long term, the compounding effect, which is the effect of the daily rebalancing to keep the leverage constant, is something that people should understand. And over the long term, the leverage and the effect of this compounding means that you almost certainly won't get exactly 2 times the return of the underlying asset because of this rebalancing and compounding effect. So that's a sort of buyer beware there in terms of holding for the long term.
Okay, something that those thinking about using them in that way should understand. Absolutely agreed. But obviously less of an impact in the short term. So, well, with that knowledge in mind, let's turn to some of the top performers we've seen in the NASDAQ. Now, this list was compiled this morning. These are the top 20 performing stocks in the NASDAQ 100 over the last 60 days, 60 trading days. And I just pulled them out to sort of show where there's been a lot of interest, because top performing stocks obviously are attracting a lot of investor interest, but also to show where GraniteShares have staked their flag in this, and how they've nominated stocks and offered instruments, ETFs, over stocks that are top performers. And there we are, right at the very top of the list, Will, Palantir.
Yep, Palantir has been an unbelievable performer. So much so, Mick, that our PTIR, which is the ticker for Palantir, the share price has gotten so high that we're almost certainly going to have to execute a forward stock split to bring the share price down to make it more affordable for people.
Wow.
So that gives you an indication of how much that thing has ripped this year. So really quite incredible.
Yeah, fantastic. And I can't help but notice at number 10 there. Now, the GraniteShares NVDL ETF is one of the most popular trading instruments on our platform. I note too that it's got a very solid amount of funds invested in it. Is it the number one single stock ETF at GraniteShares?
Yeah, it's actually still the number one single stock in the world, because Tesla, which is always or at least has been, I should say, doesn't necessarily mean that it's always going to be like this, but at least so far always has been the kind of the number two. And in different phases of Tesla that got close this year, but with the sort of drop off or the fall off in fortunes of Tesla versus the good performance of NVIDIA, NVDL remains the most popular, leveraged single stock in the world.
Right. Yeah, not surprising. I'm certainly seeing that in turnover on the Moomoo platform as well. Any other stocks there in the top 10 catch your eye, Will, before we go to the next 10?
Yeah, I mean, I think what you should see jumping out, with probably the exception of a couple, namely Constellation, but again, I can argue for that in a second. But this is all AI driven, and I was about to say even Constellation, a lot of that is about AI, feeding power to data centers and power for AI infrastructure. So very much this is what we see in terms of being the top investment trend in the world right now, certainly top investment trend in the US. And, I think what you're seeing a little bit is, NVIDIA has been the belle of the ball for the last probably 3 years easily. But now people are starting to look beyond NVIDIA to some of these other names. And, some of these other names are performing extremely well within the space. And I think the space is developing also. So, you have no longer just this sort of monopoly of AI being purely linked or set at the feet of NVIDIA, but now people are looking at the different sorts of ways that they can play or buy into the AI themes. So that could be anything from cybersecurity to data centers to specific chip manufacturers. But all the sort of different layers of the AI trade, and you see a lot represented on this list.
Yeah, absolutely. And in fact, on this list as well, as we turn to the next 10 top performers, a similar theme emerges from this list as well. But which are the stocks that catch your eye?
I think we started to talk a little bit about maybe trends that are not necessarily AI. And maybe Netflix is one that you can't really say is AI driven. But that's a good example of a growth company which has really sort of become the bellwether in terms of streaming technology, and that's really now the way that most people are consuming content. And while there was a bit of an arms race here in the US around streaming services, Netflix has really sort of emerged victorious, and I think that platform continues to go from strength to strength, and you see that represented here a little bit. Other names, again, you've got the AI representation firmly, within this sort of cohort here. And so this continues to be just another representation of the hottest theme out there.
Yeah, absolutely. I also note too that stable coins have been in the headlines, particularly with the float of Circle earlier in June. I noticed in overnight trading, Coinbase though seemed to move into the spotlight. And the exchange itself also getting a lot of love from investors in overnight trading. It was up around 12%, although Circle had a quieter night. Do you see that theme continuing in US markets?
Oh, definitely, and I'm almost surprised in a way that we haven't seen more crypto stocks in this particular list, because crypto is by far and away, in my mind, the second theme. If AI is the first theme, then crypto is the second theme. And as you know, Mick, the administration here in the US has sort of opened crypto and the welcome crypto and the crypto community with open arms. And so you've had, a flurry of crypto IPOs, Circle, obviously, as you mentioned, but other crypto companies coming to market. You've had flurry of activity in the ETF market with new ETF launches linked to crypto. You've had all sorts of, talk of different regulations being relaxed and, the posture of the SEC changing around it. So very much this has been a great year for crypto, a good time to be invested in that asset class. And so some of the big names within crypto, you mentioned obviously the Circle IPO, but Coinbase is up handsomely, again, beating the market year to date, along with the old favorite MicroStrategy or Strategy B as they're now called, of course. But a number of crypto names that are worth mentioning in terms of, again, being part of this big trend that is benefiting from Mr. Trump and the administration.
Absolutely. AI and crypto both running very hot at the moment. Thanks for the rundown there, Will. There's plenty more to be said there, but in the interest of time, I'd like to get to some of the questions. I see quite a few still coming through. Thank you for those. Please keep putting your questions into the comment section. And as I say, we'll get to as many of them as we can. I think we better get started here, Will, because we've got a lot to deal with. Perhaps you'd like to take this first one. How should newer investors think about responsible leverage usage in today's environment, especially with trading derivatives on Moomoo's platform?
So what I'd always say is I think, when it comes to anything to do with leverage, I think that, that is a tool for sophisticated investors, meaning that like all investments, but particularly when you're using leverage, the swings can be big, the ups and downs. So certainly you never want to invest in anything you don't understand. So you got to fully understand, what the product is, how it works, and how it may function. And then I think for people that are getting into the first time, if they are, doing it for the first time, do it with amount of money that is easy for you to think about losing, or in other words, you're not going to lose any sleep over in a night, and get a feel for how the product works. And I think, become a practitioner is ultimately the best sort of advice that I think anybody can have really when it comes to investing. But start slow, make sure you understand what you're doing and see if it's the right fit for you. Yeah,
absolutely essential, isn't it? And that doesn't just apply to ETFs. Whether you're investing in a company, an ETF,
that's right,
or another derivative, understanding what it is that you're buying into is very important. And I really like your point there about starting small, starting slowly, and building your knowledge and your experience as you go. Well, here's another one for you, though, Will. As passive investing grows through ETFs, what role do thematic ETFs like AI, clean energy, etc., play in long-term portfolio construction? Actually, I've got a few thoughts on that one as well, but please, what are yours?
I think that what we're seeing is a shift in what you might call the traditional portfolio, the so-called 60-40 portfolio, which historically used to be, give or take 60% equities, 40% bonds or fixed income. And that was your kind of standard, fare that financial advisors here in the US would serve up to clients. And I think that's changing, and it's changing for a number of reasons. But ultimately, I think where we're going to a portfolio that looks more like your sort of basic ETFs, generic, long-term, low-cost S&P 500, NASDAQs, etc., for the vast majority. And then we are going to much more specialist ETFs for the remaining, could be 20%, 40% of the portfolio, where people are going to start to employ very specific ideas that they have high conviction in. And those could be themes, the likes of what you just mentioned, Mick. There could be leverage, it could be high yield, could be cryptocurrency. But that's where we see the market sort of moving much more in that direction. And I think the bottom line is you can have both, but where we see the most excitement in terms of what people really get into, they talk online about it in communities, they do their research, they follow it, are things like themes, are things that fit more into this sort of specialism bucket, in I think, the modern portfolio.
Yeah, I'd have to agree with that. We're certainly seeing similar things on the Moomoo platform with particularly those who appear to be investing for the longer term, taking what they call here a core and satellite approach.
That's right.
And you're absolutely right. They've got a diversified ETF at the core, and sometimes several of them, sometimes international, sometimes local, once again, sometimes both. And then around that, they'll arrange satellites. And they tend also to be, what we've noticed, shorter term holdings. They look for exposures or thematics or industries that might be sort of on a time frame from a week to 6 months, whereas their core portfolio might not change at all over the course of the year. So certainly seeing that as popular. And you're absolutely right. There's also a push here towards more alternative investments. Private markets have seen a lot of growth here in Australia, and one of the reasons driving that has been a desire for exposure to asset classes that are not well represented on the local exchange. So one of the steps, of course, has been that they've moved into international exchanges like the US, but another has been a push into ETFs that offer exposures like crypto exposures, so that they can take that exposure without actually having to go onto an exchange and create a wallet and go through all the steps required there in crypto land. So certainly growing in popularity, and the increasing participation of individual investors directly in the market, I think, is also one of the contributors to those themes. So thank you very much for that question, whoever sent that one in to us. Moving on to the next one. How can we deal with this market volatility, especially Trump's tariff deals and China's strategy in dealing with it? What do you think, Will?
I mean, I think that more broadly, the question is a good one around how to deal with volatility. And really, there's sort of two approaches. There's the, stomach the volatility. In other words, if you have a longer term time horizon, then the volatility should not really be a major consideration. That it's something you just have to deal with, stomach it, and be optimistic, be thoughtful that markets typically go up over the long run. The other side to it is, of course, volatility presents opportunity. And if you're prepared to be more active in the volatility, you see huge movements. I mean, you showed obviously the chart earlier showing the NASDAQ, but that huge sort of V shape there, provided all sorts of opportunities for people. And we saw, in particular, very aggressive dip buying, almost throughout this year, sort of so far, particularly in some of the bigger, more popular names where, people had confidence in the name. They knew that ultimately the trade war, the trade strategy had to end, had to conclude somewhere. And, companies like NVIDIA, things are not going away. And irrespective of the tariff environment, corporations will find a way to do business with customers kind of around the world, and these companies will grow. And I think even again, if you think longer term, even if you were super pessimistic about what was going on with tariffs and particularly the Trump administration, bear in mind that he's only in power for 4 years. And so again, if you're a longer term investor, that might be a short time period for you to think about, a potential portfolio that lasts 20, 30, 40 years from now. So, it really just depends on the framing of it and your perspective on, I think, the time horizon, your ability to stomach volatility, and whether taking advantage of volatility is something that appeals to you.
Right. Once again, coming down to the questions that only individuals can answer for themselves, but an important take. Having said that, short-term impacts are more important to some investors and traders. And I know we've got another question here. What will happen to the market in July when 90-day tariff deals finishes? It's an interesting question. The market has concluded, I believe, that tariffs are not likely to be a permanent part of the landscape. The market seems to have disregarded them, and the rally back since that tariff-related sell-off suggests that as well. So the reality is, if they were to be reinstituted in a way that the market was convinced that tariffs were actually coming back, we could see a negative reaction. It's something to look out for over the course of July. Is that sort of the feeling on the ground there in the US, Will?
Yeah, certainly it remains a risk, but I think it's a lot now. It's a lot lower risk than before. And I think, what the administration have clearly found that tariffs are not popular. It doesn't matter whether you're a believer in them or not, but certainly there was a huge amount of negativity. The market sold off. No one likes that sort of negativity, and probably most importantly, a sitting president as administration. So I think they're very keen to move beyond this. They already started to move beyond this with the big beautiful bill. So going on to tax reform, going on to deregulation, going on to other objectives and priorities that they've had. I mean, to some degree, you could argue that that's been derailed by what's been going on in the Middle East and also with Russia, Ukraine. But I think they're willing or ready to move on. I think the template, broadly speaking, is there from a tariff perspective. And yes, does that mean that there could be another tariff shock potentially? But I think it's a much lower risk than it was a couple of months ago. Okay,
that's good to hear. Well, this one's definitely in your wheelhouse, Will. What are the unique advantages of leveraged and inverse ETFs versus traditional ETFs?
Yeah, I mean, I think that, when it comes to leveraged or inverse ETFs, as we've talked about, they're specialist tools, within the toolbox. So these are, very specific ETFs that give a specific outcome, be it a leveraged long or leveraged short or inverse outcome on an underlying asset, be it an individual stock or an index. So these are, for short-term, trading type opportunities where people are or have high conviction views on the underlying stock or underlying index, that they're looking to amplify gains or potential gains in that. And that's a different game to, let's say, a lot of traditional ETFs, not all of them, because clearly traditional ETFs, we have to define what that means. But let's, for the sake of this conversation, assume that these are the big, broad sort of equity indices, be it US indices or global indices, that these are much more, diversified, typically buy and hold opportunities, set and forget. The core parts of your portfolio that you probably really shouldn't touch. And if you can, be able to sort of continually invest in an allocation to those things on a fairly frequent basis.
Okay, well put. Thank you. All right. Moving on to our next set of questions. And this is one that comes up regularly at forums here. Can you please share if a recession is imminent and what we should do in times of crisis like this? Should we ramp up our investments or should we put more in cash? Well, first of all, I'd like to state we can't give personal advice, and that the decision as to how you respond to any potential crisis is up to you. But Will, do you think a recession is imminent?
I don't think it's imminent. And the recession narrative has been definitely out there for the last couple of years, and was certainly crescendoing around the April sort of tariff peak, when you had various sort of talking heads, going on national television talking about, not if we were going to have a recession, but when exactly it would start. That all seems to have blown over for now. But again, of course, that is still a risk out there. I just don't see any sign of it at the moment for the reasons that we've talked about already in the webinar. Growth is good, unemployment is low, interest rates are coming down, inflation seems to be in check. So the consumer still seems to be willing to spend money. So all of these things are positive. And I think to the point about, let's say if there was to be a recession, it goes back to that volatility question, which is, it depends on what your investment objective is, what your investment style is, what your attitude to risk is. And again, very clearly, you'll have, at the risk of oversimplifying, you'll have those investors that want to lean in to that situation. Those investors that want to so-called buy the dip, knowing that tomorrow, metaphorically speaking, is going to be better than today. And then you're going to have people who are more cautious, who want to take risk off the table. Neither approach is right or wrong. It's about what works for you and what is comfortable for you.
Yeah, absolutely. I'd like to echo that. That's exactly the fact. In fact, it's often referred to here as a sleep at night factor. And some people think that if you can sleep at night, then your portfolio is not risky enough. I don't subscribe to that point of view. A good night's sleep helps make better investment decisions.
A lot of there was a lot of these Warren Buffett videos, circulating at the height of the tariff thing, and one of them, he's quoted directly just saying that, in a sort of question like that, like this, what you're asking, Meg. He said, well, for an equity investor, if you can't stomach a drawdown of 50%, you shouldn't be in equities. In other words, be very direct, say maybe this is not the thing for you. Maybe stock market investing is something that you should not be involved in, because to be an equity investor, you have to be able to stomach big drawdowns. It's not always going to be going to the upside, bottom left to top right on the chart. So I think that was kind of an interesting site, and maybe that is a good rule of thumb.
Absolutely. Every investor should plan for periods of volatility and big drawdowns in the market. It's part of the investment scene. Now, here's one. Could you advise for new investors what to look out for when picking stocks or ETFs to invest in?
In terms of picking stocks, that's very difficult. That's really so subjective. I think it goes back to what I was saying about ETFs, which I'll come on to in a second. But I think at the absolute bare minimum, you should understand what the company is that you're buying into, what they do, how they make money. And ultimately, I think it's probably got to be a company that you have some kind of personal enthusiasm over. Moving on to ETFs is a bit more simple, because ETFs are really a fund wrapper that contains all sorts of investments. So the understand what you invest in is hopefully the first thing that everybody should be doing. But then really there's a kind of like the Apple phrase, there's an app for that. There's an ETF for that, chances are. So whether you're looking for something that's very, very conservative, whether it's a money market like return, US treasuries, whether it's corporate bonds, whether it's a broad equity index, a theme, cryptocurrencies. I mean, there's something for everybody. And I think, one thing with ETFs is that there's plenty of good websites out there. So you can look at what funds do, plenty of great information. All issuers are required to publish the holdings of the ETF on their websites every day. And there are plenty of other third-party websites that also do this. So you can see exactly what it invests in. And it's very easy nowadays to do things like look at the costs, compare costs of different offerings. And really, again, I think the investor, to maybe state the blindingly obvious, investors never had access to so much information as they do now. Never been in a better position as far as education and access to information.
100%. Well put. Okay, well, we've got a couple of questions here which we've to some extent dealt with in terms of current market volatility and rising tariffs. We've had a look at those and mitigating volatility and with leveraged products. Let's move on. Oh, here we go. Here's a personal question for you. Well, what energizes you daily? What keeps you up at night?
Well, I think on the business side, clearly running a company where we operate in the US, we operate in European markets, in Asian markets, obviously Australia as well. So running a global business certainly keeps me up at night. And then obviously with kids as well, that in a very different way and for very different reasons, kids keep you up at night as well. So sometimes keep you energized, but probably more often than not, it goes the other way.
I think you're being generous there, Will. I certainly remember when mine were young in particular, but we won't get into that right now. Let's move on to our next set of slides. How should newer investors think about responsible leverage? Well, I think we've touched on that. What makes GraniteShares investment solutions attractive? Well, there's a bit of a Dorothy Dixer for you, or a bit of a softball, Will. What makes them so attractive?
Well, again, this is very subjective, because what's attractive to one person is not necessarily attractive to another. What I would say is we try and curate a portfolio of investment ideas where we have something for everybody. And we try and do that to offer investment solutions that will work for investors irrespective of the market environment. So we as a company have to be able to last through market cycles, good or bad, and therefore we have to offer our investors investments that do the same. So some of those things could be everything from physical gold, which is a core sort of ETF in our portfolio. That's our BAR ETF, so very low cost and easy way to own physical gold. That's been very popular in this particular market environment. But I would argue that in some respects, gold is always popular and arguably should be considered as a permanent piece of real estate in a diversified portfolio. So you have strategies like that. We have more traditional commodity, equity, income strategies. And then obviously the leveraged ETFs that we've talked about, where we've really pioneered this new type of ETF, particularly leveraged ETFs on single stocks, both long and short. And then Yield Boost, which is probably the latest thing that we've done, which is a family of ETFs that seek ultra high yield or ultra high income distributions. And they pay them out on a weekly basis. So you're literally getting a check on a weekly basis. And these use options to make very high distributions, and they're on individual underlyings or linked to individual underlyings like Tesla, Nvidia, et cetera, and to indices. That's a very interesting play for those that are looking for very high income. And again, goes to the specialization where we see this sort of bifurcation, whereas once upon a time, maybe somebody bought one fund and it was sold to them as being, so if you get a bit of growth and a bit of income, and really what you got was probably neither growth or income. And now I think people take their proverbial $100 or whatever and say, okay, I'll put 50 into actual growth, real growth, and $50 into real income, and have specialism to generate that, and probably the sum of those parts is more effective. So yeah, I mean, we have, again, we like to think we have got something for everybody, irrespective of investment styles, time horizons, experience, etc., risk tolerance. So we try and bring ideas that are different, differentiated, that are really sort of unique to us.
Outstanding. Thank you. And I'm glad you mentioned the yield boost. It's one that's caught my eye. I was on your website this morning having a read. Very interesting product. Moving on, the next question, is this the beginning of the end of US exceptionalism, and should investors pivot elsewhere? Well, that's an interesting question. And I must say the conversations around the idea of US exceptionalism and the concept of de-dollarization, the conversation is very different on the ground in the US to ones that are held outside the US. Do you have a take on this one, Will?
I mean, US exceptionalism means different things to different people. I would frame it in terms of, do I think that the US growth story is over? And I think 100% no. 100% no. This is an amazing country. I do business all over the world and deal with businesses, customers, regulators, etc., all over the world. I can tell you that there are very few places, if any, that you'd want to do business in other than the US. It's got so much going for it, whether it's demographics, whether it's things like the rule of law, approach to business, attitude from investors, from people. So definitely I wouldn't bet against the US. Now, that doesn't mean that there aren't going to be opportunities elsewhere, or there are no opportunities elsewhere. It just means that from my perspective, the US has got plenty more room to run.
Terrific. Well, so let's jump down to the bottom of the sheet there. Will the next bull run be made in America or led by Asia?
Well, I think the bull run starts or is in the US. And this is something that has been going on for a while. Maybe there was a bit of a dip, clearly the beginning of this year. But I think if you rewind the clock back to the announcement of Trump winning the election, the attitude was among the most bullish I've ever seen in terms of the outlook for the US market. Now, all that all changed, dramatically at the beginning of this year. But I think, as we move past tariffs, people are starting to move past that. The market's back at or near all-time highs. Things are looking good. I think the bull run looks like it's going to stay in place. And at least if you look at the chart that you showed, Mick, you could also make an argument that it's just a bit of mean reversion and we're on trend. Your long-term trend here is bullish. But again, I don't think that means that you can't have bull markets in other countries and other markets around the world. It's not just the US and nobody else. It's the US plus favorable conditions. As you mentioned just a second ago, Mick, de-dollarization. But, if we're in an environment where, the dollar weakens and will weaken further, well, that benefits emerging markets, that benefits countries that are importing from the US, that benefits plenty of other people around the world. So it's not just that, but again, I'm very bullish on Asia too, in terms of there are a lot of countries in Asia that have the right demographics, the right growth profile, attitude to risk, really sort of have the right sort of business first mentality. So I think it's not going to apply universally, clearly, but the US will be fine, and there will be other opportunities as well, including in Asia.
Yeah, I'd certainly echo that. And in fact, of course, on this side of the world, we watch the Asia markets very closely. And I note, despite the fact that the Hong Kong market has finally caught up to some extent with the rest of the world. In valuation terms, it's one of the few major indices that I think could be argued is in value territory as opposed to having a frothy valuation. So there are some arguments on the side, and I think you point to that bull markets can occur simultaneously all around the globe, and in this interconnected world are more likely to, means that the question, while an interesting one, might not be particularly relevant when it comes to the investment decisions.
Yeah, and I think at the core of that, Mick, is again we go back to the themes. So the themes is AI, going to be a theme that dies out, over the next year or two. And I would strongly argue that is absolutely not the case. It just so happens that right now, the leading AI companies in the world are based in the US. Right. Now, again, there are other companies around the world, we know them well, that are actively involved in AI. But I think, again, it starts with, what are the key investment themes that will change the world over the next few years? And right. If you look at AI, where are those companies? That's in the US. Cryptocurrencies, those companies are in the US. That's what puts the US at such a good advantage.
Yes, understood. All right, terrific. Well, we're getting close to time. Well, we've got time for just a couple more questions. One coming through live is any commentary on the stocks in the defence and oil and gas industries with the ongoing conflicts?
Yeah, I mean, I think, defence stocks have gone to the moon. That's been a huge theme over the last couple of years, especially obviously since the Russia-Ukraine war started. And there's been a very popular investment theme, and we've seen defense, ETFs being cut always till Sunday in terms of whether it's global defense, whether it's US defense, European defense, different potential other countries' defense. And so I think while that theme has been incredibly strong, I sometimes wonder, how much room there is to run in that. Hopefully, for the sake of the world, that we are in an environment where perhaps peak fever over armaments and countries ramping up defense. Maybe we've seen the peak, but that certainly has been a key theme. I think in terms of energy, it really sort of comes down to AI again being the big driver. That's the big bright spot in energy markets as far as I can see. We saw that earlier on one of the slides in terms of the performance of Constellation. The major oil companies, the traditional oil producers, I guess, haven't had a great time with oil prices around these levels, certainly since the administration came back in. But indeed, even before that oil and energy prices have been in a bit of a slump since the peak after, again, Russia-Ukraine. So I think that there's a lot to be excited about on the energy front, but I think on the energy front, that is much more related to, again, the key investment theme, which is AI, and that's about power and power distribution, which involves nuclear, it involves gas, it involves getting more power to the grid, particularly, obviously, I'm talking specifically from the US perspective, but it's a phenomenon that you'll see all around the world as people look to try and find enough power to support AI over the next few years.
Yes, we've certainly seen that impact, as you say, around the globe. Locally, we've seen very good support for nuclear stocks or those that can mine uranium. And even though many of them don't actually have operating mines, the sentiment in that sector was so hot that they were running along with those more traditional energy providers. Well, I think we're going to have to call it there. I'd just like to take a second to thank you very much for sharing your knowledge and your view from the US with us. Some invaluable information there, and particularly around the use of leveraged and inverse ETFs. So thank you very much. And I'd like to thank all those people who also sent through their comments and questions. Apologies we didn't get to them all. The live recording will be posted, and we'll try and answer more of your questions with that post. So look out for that to go up later today. Well, thanks for your attention today. Keep an eye out. We'll have regular Moomoo sessions online. The next one will be towards the end of next month, and keep an eye out for further information on the website. I think, Will, we've got to let you go now. What time is it locally, Will?
It's just gone midnight here.
Well, thank you very much for your generosity, Will, and we
No
won't
problem.
take any more of your time.
Absolute pleasure. Anything for you, Mick.
Good man. Thanks, Will. Bye now.
Cheers. Thanks, everyone, for listening.